Hey soldiers, do you know how banks make money? Do you really know how banks make money? Well, something happened to the banking industry in 2020 that did two things. It gave them additional power to make money. I mean, it really supercharged it. And it also put your money in the bank at greater risk.
Not so funny now, is it? Funny man.
Now, we're going to talk about, I always say, if you want to make money with a bank, then you should look at investing in a bank or owning your own bank. Okay, and you can do that. I always tell you that, in my opinion, putting money, well, it's actually more than my opinion, it's a fact. You put your money in a bank in a savings product, it's not going to work that hard for you. I mean, you can look up the rates and you can compare those to inflation and you can judge for yourself. A few videos ago, I like to call them reports, not videos. A few reports ago, we actually broke down the rule of 72 that shows you how hard your money is working for you by demonstrating how long it will take at a certain interest rate for your money to double. All you got to do is take 72 and divide it by whatever your interest rate is. So, for example, if you're getting 1%, divide 72 by 1. It'll take 72 years, because 72 divided by 1 equals 72. It'll take 72 years for your money to double. That's how hard your money is working for you. Not hard at all. So deposits, money on deposit in a bank is really not stressing itself too hard. Now, do you need money in a bank? Yeah, if you want to be transactional, again, we talked about it again and again and again. If you want to go, you want to buy, some lunch at Burger King or wherever it is you frequent, they're not going to take gold. Most of them are not taking crypto. They're not taking silver, and they're not taking, a fraction of an insurance policy. They're also not taking equity in a home unless you've unlocked it and got it in cash. So you do need a bank for those purposes, especially in the 21st century. But let's walk through why, or more appropriately, what happened in 2020 and how it made banks potentially much more profitable and at the same time put your money at greater risk. All right, first, we have to understand the operating system of a bank. It's called fractional reserve banking. What exactly is it? Let's go through it step by step. Most large economic systems today use fractional reserve banking to stabilize and grow their economies. With fractional reserve banking, banks can lend out deposits with interest to amplify the economy. Now, what is meant by that? Of course, if you are taking in deposits and then you're lending some of that money out, making interest on it, you, as the bank, are making money, or an investor in the bank, you're making money, and you're really helping the society in general to create asset growth. So you go to your local bank, you get a mortgage, you buy a duplex, you rent it out. So you provided some housing, you own real property, you can leverage that real property because you bought it. Sure, let's say the price was $100,000, okay, you spent. You came up with $20,000 as a down payment. So for 20% of the purchase price, you control 100% of the asset, and you're able to make income off of it. You're able to participate in the appreciation of value of it. You're able to get tax advantages off of it. You're able to take equity out of it, and so on and so forth. You could even use it as leverage to purchase another rental property if you are so inclined. So that's how banks help the economy move forward. I don't want anyone to think that I think banks are evil. I don't. I do think that, there are risks to putting money in a bank, and the major risk is that your money's really not going to work hard for you, because their model says we're going to be super duper profitable by paying the depositors one interest rate and then going out and charging our credit card customers, for example, a whole different interest rate. So you come in, you get 1% on your savings account, and then the folk that are paying for interest on the bank's credit card are paying 16%, 15% spread. That's significant. The Federal Reserve Bank was founded in 1913. Interestingly enough, that's the same year that the income tax officially started. And the Federal Reserve Bank was founded ostensibly to better regulate the banking market so that banks didn't run out of money and people could get access to more lending opportunities. Some people believe that lending and borrowing is not a good thing. But trust me, if we couldn't lend and if we didn't have lenders and we couldn't borrow, our lifestyles would be totally different. Okay? So lending and borrowing is I'm not going to say it's a modern characteristic of the economy because it does go back quite a ways. But there was a point in the history of this nation, of this world rather, when usury was considered a sin. And in some religious traditions today, borrowing the way we do it or the way we have become used to it here in the Western world is something that some religions shy away from. They want to do other things to perpetuate the economy. So there's more than one way to skin a cat. Understanding fractional reserve banking can give you more trust in the banking system and lead to better money decisions to grow wealth. And we just walked through an example of that with real estate. Now, how does fractional reserve banking work? Fractional reserve banking is a system where banks are only required to keep a fraction of bank deposits on hand. That means your bank holds a percentage of your money, lending the rest of it out, or investing that money to grow their available funds. So you deposit $100 in the bank, you're letting it sit there, and they're doing things with they're keeping that money moving, which is smart, okay? That money has to stay moving. Otherwise, it's not working. It's not doing anything. If you lay in the bed all day and you don't make any money, it's not going to be good. Same with your money. Banks can use these loans, of course, to stimulate the economy, making cash more available to those who need it. This provides more opportunities for people to do things like buying a house or starting a business. Historically, the Federal Reserve set the reserve requirements on transactional accounts, such as checking and savings accounts, at 10%. Hang with me here. So if you had $10,000 in your savings account, your bank could use $9,000 of it. However, as of March 26th, 2020, the Federal Reserve no longer requires U.S. banks to keep money in reserve for transactional accounts. This idea stems from, the Fed wanting money to be freed up to lend. Okay, now, this is, some people have a problem with this because we were at, a healthy clip of being able to lend out 90% of the money, but now that cap is off and you're able to lend out 100% of the money. With these loans, banks can charge interest. So this benefits the bank tremendously, okay, especially in a rising interest rate environment. And they'll use that interest to pay for their expenses, grow their business, free up even more money to be lent, okay? And the cycle just continues. This is why banks, and again, you've got to always do your due diligence. Banks tend to be, they're well run. Banks tend to be a hell of an investment. You think about banks like JP Morgan, Citibank. These banks have been out there for, quite some time. I mean, the better part of a century or more. Just like a lot of the more well-known big insurance companies, these financial institutions with strength. Now, that does not mean that just because they've been out there for a century or more that they are impervious. They can just do anything they want and not suffer any consequences. So this is why you can't just take a metric like, oh, they're 100 years old and go and invest in that. Now, the fractional multiplier effect, what is it? It's also called the deposit multiplier. It's how banks can create money based on each unit of money they hold. This multiplier is a rough estimate based on the funds held in reserve to forecast how much money can be made off of the remaining money. It's a very simple calculation, kind of like the rule of 72. To start, divide 1 by the percentage held in reserve. So for this example, let's use the 10%, even though we know that the Fed has relaxed that requirement and they can lend it all out now if they want 100%. But let's go back and use the 10%. Once you have this number, you have your deposit multiplier. The deposit multiplier in this case, equals 1 divided by 0.10 for 10. Okay, so that means that for every dollar left in reserve, you can estimate the bank will create $10. This estimate breaks with the fact that banks are no longer required to keep a percentage in reserve. We just mentioned that. Still, the equation illustrates a powerful effect. The lower the money in reserve, the greater the amount that can be created through lending. Okay? So again, this is a license to create money pretty much out of thin air. Fractional reserve regulation. Before founding the Fed in 1913, the U.S. government established the U.S. central banking system with the National Bank Acts of 1863 and 1864. These acts set the reserve requirements of all banks at 25%. So back in the day, you could only lend out 75%. You had to keep 25% on hand. This was heavily dependent on the type of bank, but in general, it was 75%. Now, since 2020, and we all know what happened back during 2020, banks have not been required to hold any of the money in your savings or checking accounts on reserve. This was done in an attempt to stimulate the economy, and it could change again if the Fed deems it necessary. Now, here are the pros and cons with this. With any financial system, there are going to be pros and cons. The same is true with the fractional reserve banking idea. Pros include it allows the banks to utilize money that will otherwise just sit unused. Money sitting unused is not profitable at all. Number 2, it lets banks lend money to individuals and businesses who need it. This grows our economy. Again, you want to buy some real estate, you want to start a business, you want to finance an existing business, buy new equipment, hire new people, grow. Fractional reserve banking and lending makes this happen. Now, from the standpoint of being an investor in a bank through these loans, banks collect fees and interest, growing returns to fund even more loans. Okay, so it's a nice little cycle that's going on there. Now, you got to take the bad with the good. What are the cons? This increases the likelihood of bank failure if too many people withdraw their money at once. This happened during the Great Depression, just 16 years after the Federal Reserve was created. Also, some economists believe that the economy will be overstimulated and ultimately crash if there aren't enough reserves. Now, the reserve requirement was out there for 150 years, and it's been totally quashed at this point. Is this a good thing? Does it provide me with some apprehension? It actually does. Not that keeping 10% on hand was any, big giant amount. You had the 25% that, was required back in the day, and that still didn't, stop major recessions from occurring. In fact, those acts that, set forth the 25%, they were back in the early 1900s, and it didn't stop. That 25% reserve requirement did not stop the Great Depression from occurring. People, ran to the bank and started taking money out, and the system just collapsed. We'll go over the Great Depression at one point or another in a report. It's a fascinating piece of history that I think everybody should be well aware of, but it's not as cut and dry as you might think. There were several different aspects to the Great Depression that caused that to occur. And there were certain people who actually got rich during that time. Joe Kennedy, JFK's father, was one of them. I'll just say this. He is one of the folk that was out there wheeling and dealing with stocks. And, there was some malfeasance that he was engaged in. And he ended up becoming the first SEC chair, the Securities and Exchange Commission chair. I guess they figured, hey, he knows all the ropes. He was out there participating in these schemes. I guess he would be able to recognize them and help us defend against them, I suppose. Okay, the Federal Reserve has been exploring the central bank digital currency idea. We've gone over that, and we will continue to cover that. While today the only form of currency available is physical, the Fed is researching the possibility of a centralized digital currency. And I would go so far as to say we're not fully... Most of the money that I receive is digital, and it's never converted into dollars. I think many, and maybe even most Americans can say that these days. So you get a commission check, or you get a paycheck, or let's say you've got a monetized YouTube channel. They're transmitting data to your bank account that says this is how much money we're paying this person. Okay. And then usually Americans are having that money on a debit card or something like that, and they're moving money electronically. I don't know about you, maybe, say your piece in the comments, but I don't use, I don't see cash that often anymore. But the CBDC, or the central bank digital currency, is a whole different animal, because it injects an element of control over your money like you wouldn't believe. Okay, the government will be able to. It's even thought to be a threat to private banks in some different scenarios, because the Federal Reserve would hold the money. Now, I will say this: there's a unique characteristic that we have here in America, where the relationship between our central bank and the private banks is such that they own the central bank. The private banks actually own the shares of the central bank. So I'm not sure if it would be as easy to quash private banking here in America as it might be in some places, like Europe, for example. The European Central Bank is not owned by the banking industry in the country. The Bank of China is not owned by if there is no private banking industry really in China. But you get the picture, okay? The Bank of England is not owned by the banking industry in the UK. Those entities are owned by those governments. The European Central Bank is owned by the EU. The Bank of England is owned by the UK government, on and on and on. And of course, China owns its central bank. The Chinese government owns its central bank. Now, one of the greatest tricks played on the American public, and maybe the world at large, is that the Federal Reserve Bank is neither federal, it has no reserves, and it is not a bank, although it is owned by banks. We recently did a report talking about a major bank that actually is having problems with depositors saying, I want my money. I don't trust you anymore. Investors also are saying, hey, wait, they're backing away from this bank. Now it's time to watch that video. Now that you know what's going on, a little bit deeper, understand what a bank run actually looks like and how it can have a deleterious, detrimental, and material effect on the money deposited in those banks by people like you and me. Okay, guys, I'll talk to you soon.